Dear friends, we shall now go to chapter 2. Chapter 2 is entitled Risk and Insurance. Risk is inherent in insurance, so we have to study this chapter very carefully. What are the learning objectives? By the time we complete this chapter, what are the things we are supposed to know? We should be able to, after studying this chapter, explain the concept of risk in terms of insurance, explain the main components of risk, describe the risks that can be insured, describe the importance of an insurance as a risk transfer mechanism, explain the concept of pooling risks. That is our job. Now, first of all, we shall examine the concept of risk. What is this concept of risk? I will first give you the definition of risk. Risk is the chance of a damage or loss. Sometimes they say risk is doubt concerning the outcome of a situation. There are so many definitions for risk, and these are two of them. And another thing is, risk is something or someone considered to be a potential hazard. Risk can also mean a person. We can say he is a high risk case, his is a low risk case. So, a person also can be referred to as risk. In life insurance, the word risk is used to describe the possibility of an unfavorable event occurring. For example, untimely death or unforeseen disability. So, risk might mean either the chance of damage or loss, or when we are not sure about the outcome of a situation, or it also refers to a person who is offering high risk or low risk. So, a person also is referred to as a risk. Then, during the lifetime of an individual, he is exposed to many risks. Some of these are living too long beyond retirement, what we call retirement income, illness, premature death, untimely death, family protection, then accidents, lastly unemployment. These are the various risks to which we are exposed during human life. Some people unfortunately don't have a good attitude towards risk, how to take care of risk. Some people are very indifferent, they are very careless. Some people are willing to retain risks. They don't want to transfer the risk to an insurer company, to an insurer who will take care of it. They are willing to retain risks and carry them themselves, while others act cautiously and transfer them to an insurance company. Don't keep your risks with you. When the insurance companies are prepared to ease your burden, they will take upon themselves that risk and they will bear it for you. Only thing is you have to pay the premium. So, risk retention, some people carry risk themselves, then risk transfer risk to insurance companies. Risk transfer should be the choice of everybody because it is safer for us. There is no need to bear a risk when there are people who are prepared to bear the risk for you. What are the components of risk? What are the various components of risk that we shall examine? First and foremost is uncertainty. They will insure only an uncertain event. If there is certainty, they will not bear the risk. Supposing a person is on his deathbed, it is certain that he is going to die within a week or two. Such a person cannot be given an insurance policy. So, where there is uncertainty only, people would like to have an insurance policy and insurance companies also will give. You may ask, death is certain, no? Everybody is sure to die someday or other. So, when death is certain, how are the insurance companies able to give policies on something which is certain? Now, here the point is, the greatest certainty is death, but the greatest uncertainty is the hour of death. Though death is sure for all and common for all, we do not know when we die, and that is what makes us take a life insurance policy. So, uncertainty, it is the uncertainty about the timing of death. Because that uncertainty is there, people want a life insurance policy and companies are prepared to give a life insurance policy. Then the level of risk is important because we have to charge the premium according to the level of risk. The level of risk is normally assessed in terms of the probability or frequency of a certain event happening and the extent or severity of the event if it does happen. Some events happen very frequently, but the loss is not much. So, there the probability of the incident of the peril happening is not much. But in some cases, an event will very rarely take place, but when it does take place, it is crippling for the insurance company. For example, under airlines insurance, we insure all the lives of the passengers who are traveling by a plane. Accidents in planes are very, very uncommon. So, mostly they will not be paying claims. But when there is an accident, crores will have to be paid by the insurance company for all the families of the people who died in the accident. So, here probability or frequency is not there, but when the event happens, the severity is very serious. The severity is much. So, the level of risk is measured either by the probability or the number of times it is going to happen, or by the loss, the great loss which it will entail when it does happen. Then peril and hazard. Peril and hazard, there is some confusion. I want you to correctly understand what is a peril and what is hazard. Peril is the event insured against, or the event on the happening of which the insurance company will make the payment. When does the insurance company make the payment? On the happening of death, or on the date of maturity, or when an illness strikes. So, that is the event. The event on the happening of which the company is going to pay is called peril. And hazard is something which will increase the chances of the peril happening. For example, death is the peril. Death is the peril, and there are certain things which will increase the chance of the death happening. And those things may be, they are called hazards. Hazards may be health hazards or occupation hazards. If a person is overweight, or if a person has diabetes or hypertension or BP, the chances of death are more. So, these things are increasing the chance of his death. These are health hazards. We also have an occupation hazard. Occupation hazards are there. People, for example, people who are in the bomb squad, they face the probability of death more. When all are running out, they have to run in and take care of the bomb. So, it is an occupational hazard. Like that, people who work in some chemical factories and all these things, slowly their health is affected. So, hazard is something which will increase the chances of the peril happening, and hazards can be health hazards or occupation hazards. Hazards are again divided into two types: physical hazards, moral hazards. What are physical hazards? Physical hazards means physical conditions which will increase the chance of loss. We have just now seen BP, diabetes, heart disease. These are all physical hazards which increase the chances of the person dying. But moral hazards cannot be measured. Moral hazards, they refer to the character of the person who is taking the policy. He is an unscrupulous businessman. His morals are very low. So, he may try to cheat us also. Actually, when he is filling in the proposal, he has to declare everything correctly. He has to disclose everything correctly. But he may be making some misrepresentations, or he may indulge in fraud. So, that is moral hazard. Moral hazard cannot be measured. We only suspect that there is moral hazard. For example, a person who is in his late 50s comes to us for his first policy. What has he been doing all these years? Probably nobody approached him all these years. Or is there something wrong? Has he gotten a disease and the doctor told him you have got only 3 months to go? Urgently he wants to take a policy and die. Such things we suspect when a person is approaching us at an advanced age. Another case is a person with a low salary wants a big policy. His salary is only 10,000 rupees a month. He wants a 2 lakh policy. How he is going to pay the premium? Is something wrong? We wonder, is something wrong? Is he already seriously ill and he is trying to hide the disease and take the policy? So, in such cases we do not have. Or if there is a bachelor, he has no dependents, he has no family, family protection is not necessary for him but he is taking a policy for family protection. So we suspect that there may be something wrong. Physical hazard, no problem. You can charge extra premium and give the policy. But if it is a moral hazard, you cannot measure it. The best course of action is to decline the proposal, because we are not able to gauge what exactly is the risk we are going to handle. We have seen already that some people are categorized as a high risk and some people are categorized as a low risk. Who are the people who are high risk cases? They are having a risky job profile. He is in a job which is full of risks and all that. He wants a policy, we will give him, but his is a high risk. So we may either charge him extra premium because the risk is more than normal. We are justified in charging extra premium. Or sometimes we issue a policy with a lien. A lien means we say that full risk we are not going to bear for some time to come. For example, he takes a 10 lakh policy. We say if the death occurs in the first year, only 5 lakhs will be paid. If it comes in the second year, 6 lakhs. Like that we spread the lien over 5 years. If he dies after 5 years, full 10 lakhs are payable. This is what is called a lien. Then the existing medical conditions or the present health of the customer also is important. The present health condition, it does not seem to be quite okay. He is young, but his health condition is not okay. That also makes him a high risk. We wonder whether to give a policy to him or not. Then lifestyle of the individual. Is he having a good way of life and good habits, or he leads an irregular life with all types of habits? Such a person is more likely to meet with death. So we are doubly cautious when we handle such cases. All these come under high risks. Then age group of the individual. So the rates of mortality increase with age. Say among people aged 30, if you take 1,000 people aged 30 and watch them for 1 year, 1 or 2 may die. If you take 1,000 people aged 50 and watch them for 1 year, some 10 or 12 may die. So mortality is higher at a higher age. That also you have to take into account when examining what sort of a risk he will make. Is he a high risk or a low risk? Some risks are insurable, some risks are not insurable. What type of risks are insurable? Financial risks are insurable. Financial risks means you pay a certain amount on the happening of a event. If that event happens, if he dies, so much is being paid to the family. Then there are pure risks. Pure risks means there is no chance of the customer making a profit out of the transaction. Either he will make a loss or there is no profit, no loss. In such cases, the policy holder has no control over the event also. Such things are classified as pure risks. Then particular risks. Particular risks are actually local in nature. A colony being swept away by a flood, a part of a city attacked by an earthquake. These are all particular risks which are local in nature. So we have seen already financial risk can be insured by the companies. Financial risks are insurable by the companies. What exactly are the events for a financial risk? Loss of life, death. On death we pay a fixed amount. All financial risks we pay a certain amount. So there will be no dispute about the amount to be paid. Disease, disability. This comes under health insurance. In case he contracts a disease or a disability, we make some payment for the treatment of the disease. Then savings accumulation. If the customer wants to take an education policy or a marriage policy for his children, we issue the policy. So we have to save the amounts and pay to the children at the time of education or at the time of marriage. Then retirement. Retirement income. Retirement income. All people are not in pensionable jobs. So for most people, retirement income is a very, very important necessity. So this also can be reduced to financial terms. So all these are financial risks and they can be easily taken by any insurance company. Pure risk we have already seen. A pure risks are those risks where there is no possibility of making a profit. We need not worry that the customer is trying to make a profit. It may be a loss or it may be neither a profit nor a loss, but there is no danger of his making any profit, and he has got no control over the event on the happening of which the company will pay the amount. But speculative risks are not insurable. What is speculative? Speculation. Speculative risks are under the control of the person concerned. He can manipulate. It can be horse racing, lottery, gambling, or speculating in the stock market. Such risks we cannot insure because they are speculative and they are under the control of the customer. That should not be there. In speculative risk, we have seen there is chance of loss as well as gain. Particular risks we have seen just now. Particular risks are personal or local in their effect. The consequences of these risks occurring affect specific individuals or local communities. For example, a theft took place in a big bungalow. That is a particular risk. Only he is affected, his neighbors are not affected. Or a colony is washed away by floods. These are all local in nature, they can be certainly taken care of. Next point we are examining is something we have already examined, risk transfer mechanism. We have already seen that insurance is risk transfer mechanism. As we saw in chapter 1, the primary function of insurance is to transfer the risk from an individual to an insurance company. The insurance company which bears the risk is known as the insurer, and the individual who transfers his risk is known as the insured. We have seen that there are two ways of managing risk. First is risk retention, not taking a policy and bearing the risk ourselves. That is not a prudent course of action. Everyone should try to transfer the risk to the insurance company. When they are prepared to bear the risk for you, you can easily pass it on to them, and they will do it for a consideration called premium, which is not much when compared to the loss involved. So, pooling of risks. How do the companies run the insurance companies? How do they know what are the actual losses to be incurred and all that? First, they gather statistics over a long period and over a large area and see how many risks are expected in a particular area. For example, among people aged 30, for every 1,000 people aged 30, how many are likely to die? Or for every 1,000 people aged 50, how many are going to die? They have got the statistics. Bearing on that, they calculate the premium and they charge the premium. So, pooling of risks is the job. Many people come there with a risk and all their cases are pooled together. Pooling of risks. With pooling of risks, an insurance company pools the premium collected from several individuals to insure them against similar risks. The insurance company maintains different sets of pools for different risks. For different kinds of insurance, there should be separate pools. You cannot have the same pool for life insurance, accident insurance, motor insurance, etc., etc., because the statistics are different and the risk is different. There should be, insurance company maintains different sets of pools for different risks. So, by pooling risks together, an insurance company is able to take care of the risk. Then, law of large numbers. What is this law of large numbers, which comes in statistics? The law of large numbers states that unless you have a number of risks taken together, you cannot have the results which you expected from the statistics. If you insure only 100 people, the claims may be much more than what you expected, and the company will go into loss. So, you should try to insure as many people as possible. If you insure more and more people, your experience will be precisely the same you anticipated while collecting the statistics and all that. So, the law of large numbers. Insurance companies apply the law of large numbers to determine the cost of total annual claims. Insurance companies determine the probability that a certain amount of claims will have to be paid by them if a large number of people are insured for a similar risk. So, after gathering statistics, they determine what the premium is to be charged, what consideration is to be charged, and if their expectations are to come true in their actual experience, you have to insure a number of people. Only then your experience will be the same that you anticipated. Now, what are the various things we have discussed so far? We shall just briefly recapitulate all the topics we have so far covered. We have seen the definition of risk. What is risk? What is risk in relation to insurance? Then attitude to risk. Some people don't want to pass on the risk to an insurance company. They want to bear the risk themselves. That is risk retention. But wise people pass on the risk to the company, insurance company, and this is risk transfer or insurance. Then components of risk. What are the various components of risk we discussed? Then types of hazard. How many types of hazard are there? Physical hazard, moral hazard, etc. All these things. Then insurable risks. Can we insure every risk that a person is having? No. Speculative risks cannot be insured, but pure risks can be insured and particular risks can be insured. So, financial risks can be insured. Insurable risks are financial risks, where you will be paying the cost of the risk in terms of money. In a life insurance policy, in case the person dies, you pay a few lakhs to the nominee. So, you will be paying the cost of the risk in terms of money. They are called financial risks. Pure risks. Pure risks we have seen are they can be insured. Pure risks can be insured. These are, the person cannot make a profit by taking a policy for a pure risk. Slight loss may be there, but there is no possibility of his making a profit, which is there in speculative risks. Speculative risks cannot be insured. Then particular risks, we have seen that particular risks are a few individuals only are affected. For example, a small colony is washed away. In a bungalow, there was a theft. Only one person is affected, not even his neighbors. So these are all particular risks, they can be insured. Then we have just now seen risk transfer mechanism. Insurance is nothing but a risk transfer mechanism. Pooling of risks. How they are able to take care of our risks? By pooling all the risks of the same type together. Life insurance risks and motor insurance risks cannot be mixed. You have to maintain separate pools for each type of risk. Then we have seen the law of large numbers. Unless you insure a very large number of people, your expectations will be upset. That should not happen. A company has to gain profits. It should not go into losses. For that, what you do is, a number of risks are to be taken together. Then there will be no problem at all. You are quite safe. Some questions and answers are there. We shall see what the questions are and what are the answers. Pooling of risk in insurance means, 1. The premium collected and deposited in a pool. All similar risks are pooled together. Premium is pooled to make claims. Contribution of insurance company. It makes no sense. It's not correct. 3. Premium is pooled to make claims. No. Contribution of insurance company. That will never happen. 2 is correct. All similar risks are pooled together. Life insurance risks are pooled separately. Motor insurance risks are pooled separately. So this is the right answer. All similar risks are pooled together. How are perils and hazards normally distinguished under term assurance policies? Term assurance policy, you know, payment is made only on the death of the policy holder during the term of the policy. If he survives to the end of the term, no payment is made. We are covering only death risk. We are only taking care of family protection. We are not taking care of retirement income here. Perils are medical factors which influence the risk of dying, and hazards are lifestyle activities which influence the risk of dying. No. 3. Perils are factors which affect the risk being insured, and hazards are the size of the risk being insured. No. 4. Perils are factors which could influence an insured event occurring, and hazards are the actual events which will trigger a payout. No. 2 is correct. Perils are risks that policy holders will die before a specified date. Peril is the event on the happening of which the company will pay the amount. and hazards are factors which could influence the risks. Hazards simply increase the chances of the peril happening. So 2 is correct. The type of risk that can be insured against is 1 speculative risk, 2 pure risk, 3 pure and speculative risk, 4 non-financial risk. No, pure risks can be insured. Pure risks, there is no chance of the customer making a profit out of the deal. So pure risks are quite okay. We can take care of pure risks. Then Vinay doesn't want to take insurance on himself. He feels that his family will survive with the funds available in the bank and monthly rentals received from village. This comes under dash risk. 3 retaining. This is what is called retention of risk. Transfer of risk is insurance. Retaining or retention of risk is the course this our friend is following. It is not a wise course. Mr. Mahesh is a software engineer. He has taken a term assurance for 30 lakhs for 30 years. This is an example of risk transfer. He has taken a term assurance policy. He has passed on the risk to the insurance company. The company will take care of him and his family. So this is a good example of risk transfer. On 6th August, there was a typhoon, a kind of a storm. Mr. Augustine, who had insurance, died in typhoon. Now, how will the insurance company categorize this particular risk? It is not peril risk or particular risk or risk transfer. It is number 1 under the category of pure risk. Pure risk can be paid. Here the customer cannot make any profit and the peril also is not under his control. So it is a clear case of pure risk. Law of large numbers help in calculating the severity of risk. No. Physical hazard, moral hazard, probability of risk. What are the chances for the risk to happen? This will be correctly taken care of if you have large number of statistics available. Only then your expectations will be sound and your experience also will be according to your expectations. So probability of risk is the answer. A person with a criminal background due to financial fraud would come under which hazard? Is it physical or moral or occupation or medical? Moral hazard. Moral hazard cannot be defined. Moral hazard cannot be guessed by us. We only feel that there is something wrong. And we have a person who has got a criminal background. His intentions are not okay. And he is involved in a number of financial frauds. So this may be another plan of his to cheat the insurance company. So where there is a moral hazard, we cannot give the policy. Physical hazard, we can give the policy by charging extra premium. Wherever you suspect there is moral hazard, simply decline the proposal. That is the only course of action. So these are the questions and thank you.